Over the last few years, public attention has remained fixed on the ballooning federal debt in the USA. Interest repayments alone have become one of the government's largest expenditures, and with new legislation projected to widen the deficit, the rate of accumulation is only expected to increase. On the other side of the Pacific, China appears to have its borrowing under control. Officially, its debt-to-GDP ratio sits at a manageable 84%, significantly lower than the 123% seen in the US. China further projects stability by using its massive savings to buy hundreds of billions of dollars in American Treasury bonds. By acting as the U.S. government's primary lender, they have secured a position of significant leverage during trade negotiations. On paper, the narrative is simple. The U.S. is the reckless borrower marching toward a crisis, while China is the responsible global bank saving for the future. However, this scale comparison reveals a different story. If you look past the official reporting, China's true debt levels may actually exceed 300% of its GDP, and some estimates suggest the real number is closer to 450%. This astronomical figure breaks into an opaque network of reporting inaccuracies and off-the-books vehicles that the state uses to fund public services without adding to the central budget. If the world's largest manufacturing hub is secretly carrying 3 times more debt than America, how does their specific financial ecosystem keep the economy from an immediate collapse? In the U.S., the federal government is responsible for the vast majority of public borrowing, and that debt is tracked openly. This branching hierarchy illustrates how China hides its liabilities by spreading them across provincial governments and hundreds of thousands of state-owned enterprises, or SOEs. These SOEs function as a bridge between private firms and government departments. They absorb massive loans to build strategic infrastructure, allowing the central government to achieve its goals while keeping the debt off its official books. We can see this in the China State Construction Engineering Corporation. It generates hundreds of billions in revenue building massive projects like the new administrative capital in Egypt, all funded through corporate borrowing rather than central government spending. While this strategy keeps the official debt figures low, it creates a massive risk. If these highly leveraged companies default, the central government is still ultimately responsible for a $30 trillion hidden bill. This gauge comparison shows a strange inversion of risk. The U.S. has to pay yields of roughly 4.5% to attract bond buyers, but China, despite its hidden debt levels, only pays 1.7%. Normally, investors would move their money to the higher-yielding U.S. bonds, but strict capital controls mean Chinese wealth is effectively blocked from leaving the country to find safer returns overseas. Domestic alternatives are just as limited. Sudden regulatory crackdowns and political interference have kept the Chinese stock market stagnant for decades, meaning investors can't use it as a reliable safe haven. This creates a captive market. State-owned banks are forced to buy government debt regardless of the risk, which keeps borrowing costs artificially low for the state. You might expect this constant credit expansion to cause high inflation, but consumer prices in China remain flat. That's because Chinese households are extremely frugal, spending only $39. When consumers won't spend, prices simply stagnate, removing the incentive for businesses to invest or the economy to grow. With the stock market suppressed and consumer spending low, almost all of China's newly printed wealth flowed into the only asset class left, speculative real estate. By outsourcing its consumption to the rest of the world, China pushed its domestic wealth into the housing market, resulting in cities with some of the most expensive property bubbles on Earth, while the consumer economy flatlined. Curious, by standard debt-to-GDP metrics, China looks like it's approaching a breaking point, but focusing only on what is owed misses the other side of the ledger, the value of what the state actually owns. The U.S. government holds relatively few liquid assets compared to its massive obligations. Once you factor in unfunded commitments, its estimated net worth is roughly negative $40 trillion. This balance sheet comparison reveals that China operates on a different model. Because the government legally owns all the land, the utilities, and the massive state-owned firms, its net worth is estimated to be positive, somewhere between $20 and $40 trillion. China's survival depends on the fact that its hidden debt was used to build a vast array of physical assets that the government directly controls. To fix its debt problem, the U.S. has to extract wealth from its citizens through politically difficult tax hikes or significant cuts to public spending and services. China, in theory, has a different option. It can sell off shares in its massive state corporations or lease more land to pay down its liabilities without directly raiding household bank accounts. Ultimately, neither economy is winning. The U.S. is struggling to manage overconsumption and inflation, while China faces a cooling real estate bubble and a deflationary trap. They are opposite manifestations of the same global imbalance.